Imagine this. You're 45. It's a Tuesday. You sit at your kitchen table with a glass of wine and your checkbook. You write a check for $42,000, the last of your savings, your emergency fund, and maybe a small inheritance. You mail it to the bank and feel awesome. You just paid off your mortgage. Feels smart, right? Responsible with adulting level 100. Fast forward 6 months. You lose your job. Your bank account? Empty. $500,000 of equity trapped in your walls. But you really can't buy groceries or you can't pay the mechanic. It's like you're sitting on gold and still starving. Welcome to the liquidity trap. The pay off your mortgage movement? It's emotional, not mathematical. Our grandparents paid off debt because they had to. In between 1930s to 1980s, the interest rates were in double digits. But today, mortgages are 3 to 4%, or maybe 5%. And that's basically stuffing money into a savings account with no flexibility and zero liquidity. Meanwhile, the S&P 500 historically returns 8 to 10%. You're giving up higher returns just because the word debt, which makes you twitchy. And that's a fear tax. Here's how banks get rich. They borrow from you at 0.5% and lend back at 6%. That's how the profit is made. You could do the same thing in reverse. If your mortgage is 4% and you invest in the market at 8%, that difference is your profit. Let's put numbers on this situation. For example, you have $100,000 extra cash. Pay your mortgage. You save $4,000 per year in interest. If you invest that, you earn $8,000 per year. Over decades, that difference adds up to hundreds of thousands of dollars. Paying off your house early kills the magic of leverage. You're just basically firing your most productive employee, your borrowed money. Most people think risk is owing money. Wrong. Real risk is not having access to money. When you put extra money into your mortgage, it becomes house equity, money you can't spend in an emergency. Compare two people, one with a paid-off house but zero cash, another with a mortgage and $500,000 in liquid investments. Who's safer? The person with cash. Options matter more than zero debt. Inflation also matters. When you have a 30-year fixed mortgage, your monthly payment never changes, but dollars lose value over time. $2,000 today could be equivalent to $800 in 20 years. You're paying back the bank with cheaper dollars. Pay off early? You lose that advantage. You're giving the bank a gift. Let inflation do the work for you. Here's the opportunity cost. If you pay an extra $1,000 per month to your mortgage for 15 years, it feels good. But if you invested that same $1,000 per month in a simple index fund with historical returns of 10%, you have roughly $400,000 in 15 years. Keep investing for 30 years, nearly $2 million. Meanwhile, your house might be worth $800,000. Difference in net worth? Over $1 million. All for peace of mind. Psychologically, a paid-off house feels freeing. But in reality, most people just upgrade their lifestyle. Bigger vacations, nicer stuff, more comfort. Keeping a mortgage enforces forced budgeting and leaves money free to invest elsewhere. Paid-off houses also attract lawsuits. You look rich on paper. Mortgage still there. Bank owns part of it. Less attractive target. Leverage is a hidden form of asset protection. When should you pay off a mortgage early? 2 times. Very high interest rate, 8% or 9%. That's a guaranteed return higher than the market. If you can't save otherwise, using the mortgage as forced discipline. Otherwise, low-interest mortgage debt is an asset. It's free money if you invest your cash wisely. Actionable advice. Stop sending extra principal. Take that $200 to $1,000 per month, open a freedom fund, and invest in a simple S&P 500 index fund. Emergencies? Money is liquid. Growth? Money compounds. Security? You control it. A paid-off house is a trophy. A growing investment portfolio? An army. Debt is not evil, it's a tool. Leverage is freedom. Zero debt can mean zero options.